Hello students, welcome to this informative lecture on the world of investing in mutual funds. Mutual fund is a popular choice among investors because it offers potential for returns like those of stock market, all while managing risk at a reasonable level. So if you are just starting your investment journey, mutual funds are often recommended as a great way to begin building wealth. Throughout this lecture, we will explore various aspects of mutual funds. We will start by understanding what is mutual fund, then why it's smart option for investment. Then we will delve into the different type of mutual funds available, and by the end of our session, we will have a clear grasp of how to choose the right mutual fund that suits your financial objective. Let's begin. In our previous lecture, we examined various asset classes and their respective advantages and limitations. This slide categorizes these asset classes based on their associated risk and potential returns. At the lowest risk level, we have cash investment like recurring deposits and saving accounts. While they offer minimum return, they are also risk free. On the other end of the spectrum, you will find derivatives, especially future and options. In the stock market, these instruments are used for trading. So you must have heard about stock trading. So the trading is basically done in future and options that yields fantastic returns, but also it comes with very high risk level potential. You can say it's the highest risk is involved in stock trading. So I advise that unless and until you have some 10 or 15 years of experience in stock market, you should not try stock trading. In the middle ground lies equity. It is represented by shares in companies. Investing in stocks can provide attractive returns, but it demands thorough research, continuous monitoring, and of course, patience. For most individuals, conducting in-depth research and keeping a constant eye on stock market price fluctuation isn't feasible. If you are interested in earning solid returns through equity investment but lack the time required for active management, mutual fund emerge as an ideal solution. Essentially, mutual fund is an investment option where individuals invest directly into the stock market through an intermediary. These intermediaries pulls money from multiple investor and make investment in stock market. The profit generated are then distributed proportionally among the investors. By opting for mutual funds, you can tap into potential of stock market without complexities of individual stock selection and constant monitoring. It's a way to enjoy the benefits of equities while leaving the active management to experts. Then what is mutual fund? Mutual fund is like a financial company that brings together money from bunch of different investors instead of each investor buying stocks or bond individually. They pool their money together in this fund, so it forms a corpus. The purpose of this pooling is to give all these investors an access to the diversified investment portfolio without having to manage it by themselves. These mutual funds then takes all this pooled money and uses it to buy a variety of financial assets like stock, bonds, short-term debts. These assets collectively form what's known as mutual funds portfolio. Now let's take an example to understand this better. Consider the mutual fund scheme called as HDFC Top 100 Mutual Fund. In this scheme, the mutual fund company, that is HDFC, collects money from lot of investors like you and me. Then they use this money to buy different things like stocks from various companies, bonds issued by the government, or different corporate companies. So if you look at the portfolio of HDFC Top 100 Mutual Fund Scheme, the portfolio is made up of 49 stocks from 15 different sectors. Each stock is carefully chosen to create mix that's expected to do well over time. Now let's take closer look how mutual fund operates. As we discussed, a mutual fund collects money from group of individuals, each contributing a certain amount. This pooled money forms a fund. The fund appoints a professional fund manager. This manager is responsible for making investment decisions on behalf of all investors in the fund. The fund manager takes the pooled money and invests it into various assets like stock, bonds, and short-term securities. The goal is to create well-balanced and diversified portfolio that has a potential for growth. As time goes by, the value of assets in the mutual funds portfolio can change. If the value of stocks or other investment in the portfolio increases, the fund experiences capital appreciation. When the value of assets in the portfolio increases, the mutual fund makes a profit. This profit comes from increase in stock prices, interest earned on bonds or other sources. These profits are shared among the investor in mutual fund. For their services, the fund manager charges fee to cover the cost of managing the fund. These fees are typically a percentage of total assets managed. So if the total asset managed is 1 lakh rupees and fees is 1%, then the fund manager yearly will charge 100 rupees from the investor. After deducting the fees and the expenses, the remaining profit is distributed among the investors in mutual fund. In essence, investing in a mutual fund means entrusting your money to a team of professionals who have the expertise to manage and grow up investment. It's a convenient way for individuals to invest in stock market without having to be a stock market expert themselves. Keeping in mind that while investing in mutual fund offer the potential for highest return, they also carry some level of risk, which is important to consider when making investment decision. So mutual funds are not really risk free. They comes with certain amount of risk. But although it contains risk, it's one of the best option to invest in. So let's see why to invest in mutual funds. The first thing to invest in mutual fund is diversification. It is said that never put all your eggs in one basket. It's a wise saying that applies to investing. It means you shouldn't risk everything to a single investment, because if that one investment goes bad, you will lose everything. So if you put all your money into stock market and if the stock market is not doing well, then you will incur loss. To lower the chance of big losses, it's smart to diversify your investment. Diversification means spreading your money across different type of investment. If one investment doesn't do well, other might make up for it. Mutual fund offers an easy way to diversify. When you invest in a mutual fund, your money get pulled with money from other investor. A skilled fund manager then uses this pool of money to buy various investments like stock, bonds, and other assets. Now, here where it gets interesting, each mutual fund can have lots of different investment inside it. This means you are not putting all your money in just one thing. Instead, you are holding mix of investment. For example, if you are invested in a mutual fund called as Global Growth Mutual Fund, it might own a slice of companies from around the world. So it is not just stick to Indian market. Also, the investment are further diversified like that. The investment is also done in tech firms, healthcare companies, and more. It could also holds bonds issued by government. Some funds might even include real estate or commodities in their portfolio. This diversification can help to reduce the risk of losing a lot of money. If one investment doesn't do well, the other will do well. It's like having a bunch of different baskets for your eggs. If one basket has a problem, the other can still keep your eggs safe. Let's explore example of HDFC Top 100 Fund to understand how diversification works in practice. The HDFC Top 100 Fund is a type of mutual fund that focuses on investing in large and mid-cap stocks. What's interesting about this fund is that it spreads its investment across different sectors of economy. This spreading out the investment is what we call as a diversification. It's a powerful strategy to reduce risk. When you take a look at portfolio of HDFC Top 100 Fund, you will notice that it includes stocks from various sectors like finance, energy, technology and consumer goods. These are just few examples, but the idea is that fund is invested in companies from different parts of the economy. Now, why diversification is so important? Let's technology sector is doing really well. Now, with this, the stock prices of tech companies will go up. At the same time, the energy sector might not be doing as great, and the energy company stock might not be performing well. So in this scenario, because HDFC Top 100 Fund has investment is in both technology and energy, the overall effect on funds value isn't drastic. The gains from tech sector can balance out the losses from energy sector. This helps to smooth out the bumps and ups and downs that can happen in the stock market. For individual investors with limited funds, it's challenging to buy stocks from all sectors and many types at the same time. This is where mutual funds comes into picture. They pool money from many investors and use that pool money to buy diverse mix of stocks. So even if you can't afford to invest in all the sectors, a mutual fund like HDFC Top 100 can help you to enjoy the benefits of diversification and potentially reduce the impact of markets ups and down on your investment. Now let's understand some other advantages of investing in mutual fund. The next is professional management. Professional management is one of the key advantages of investing in mutual funds. Let's take a closer look at why this matters. Investing in individual stock and bonds can be quite complex and demanding. It requires in-depth knowledge of financial market, industry trends, individual companies' performance, and ability to conduct thorough research. Not to mention, keeping up with ever-changing market dynamics requires constant vigilance. You have to be very alert. This is where mutual funds comes into play. When you invest in a mutual fund, you are essentially handing over the responsibility of managing your investment to a team of skilled professionals. These fund managers are well qualified experts with deep understanding of financial markets and wealth of experience in picking up right investments. So you don't have to worry. You have given the responsibility to the fund manager to pick stocks for you. Now next is liquidity. Liquidity and transparency are two important features of mutual funds. Let's take a closer look at how these aspects benefit investors. Mutual funds are known for their high level of liquidity. Liquidity refers to how easily you can convert an investment into cash without significantly affecting its price. So in case of mutual fund, if you need money in a hurry, you can usually get it without too much hassle. You can redeem your investment online and the money will get credited into your account in a day or two. It's that simple. Transparency is a key feature that builds trust between investor and mutual fund companies. Mutual fund companies provide regular updates and information to their investor. This transparency helps investor to make informed decisions. By having access to up-to-date information about their investment, they can assess mutual funds performance, understand its strategies, and adjust their investment plans accordingly. So if one mutual fund scheme is not doing well, you can withdraw your money and you can put your money in some another mutual fund. So daily you can check the value of your investment in mutual fund. It's that transparent. Now, once we have understood how mutual fund works and what are the advantages, let's discuss some basic terminology related to mutual fund. The first is asset management company. An asset management company called as AMC in short plays a crucial role in world of investment. An AMC is a company that manages and oversees various investment funds like mutual fund. The main task is to pull funds from individual investors and use those funds to invest in diversified range of assets such as stocks, bond and other securities. The goal of an AMC is to generate optimal returns for investor like managing risk. In return for their services, the AMC charges a fee, which is a percentage of total assets they manage. The total asset they manage is called as AUM, asset under management. The Securities and Exchange Board of India, SEBI, you might have heard about it, is a regulatory body that supervises and regulates the Indian capital market, including mutual funds and asset management companies, AMCs. SEBI ensures that AMCs follow the rules and guidance that protect interest of investors. It oversees the functioning of mutual fund, their operations, disclosure and marketing strategies to maintain transparency and fairness in the industry. Some AMCs in India are listed on this slide. You can take a look at it. Now, very important person is mutual fund manager. Mutual fund manager is like a captain of the ship. They are responsible for steering the funds into right direction and making investment decisions that align with the fund's goals and strategies, ultimately increasing the value of investment. Their main tasks include selecting investment, monitoring market trends, and executing trades. They analyze various factors like economic condition, industry trends, and company performance to make informed investment choices. Essentially, the fund manager's goal is to grow funds value while managing risk to achieve best possible returns for the investor. The total value of the asset in mutual fund is calculated daily. The total value is then divided by number of units of fund that investor holds. It gives the net asset value called as NAV per unit for that day. So when you buy mutual fund, you get units. So currently, if one unit is cost at, let's say 20 rupees, and if you are investing 100 rupees, then you will get 5 units of that particular mutual fund scheme. And when the value of your investment increases, the value of unit becomes more than 20, like 21, 22, 23, and so on. So NAV is called as net asset value. So what they do, they calculate the total value of the investment divided by the number of units issued, and you will get NAV. For example, if the total asset in mutual fund are worth rupees 1 million, that is 10 lakhs, and there are 1 lakh units outstanding. So the investment value is 10 lakhs. The unit distributed to the investors is 1 lakh. Then NAV for that day would be rupees 10 per unit. Investor can use NAV to gauge the value of their investment. It's like checking the price of stocks. If NAV increases, it indicates that fund's assets are growing and vice versa. Now, like IPO of any company, AMC issues units to the retail investors or institutional investor also through new fund offer. A new fund offer called as NFO is when an asset management company AMC introduces a new mutual fund scheme to the market. Each NFO comes with specific investment objectives like focusing on particular sector, industry or asset type. For instance, an infrastructure fund would concentrate on investment in companies related to infrastructure development, such as steel and cement companies. A technology fund will essentially invest in technology companies. A banking fund will invest in a stock of different banks like SBI, ICICI, Canara Bank, Bank of India, and so on. When you invest in a mutual fund, you purchase units of that fund. Each unit represents a portion of fund's total holding. In this example, each unit has a value of rupees 10. So when new fund offer is made by AMC, each unit has a value of rupees 10. This means that when you invest, you are essentially buying unit at rupees 10 each. Investor can buy these units in multiple of rupees 10 initially. For instance, if you invest 500 rupees, you can buy 50 units because 500 divided by 10 equal to 50 units. NFO are exciting opportunities for investor to get a new investment scheme right from the beginning. They offer chance to be part of fund journey from its inception. However, as with any investment decision, it is essential to carefully consider your financial goal, risk tolerance, and funds objective before investing in NFO. So, for novice investor, my recommendation is don't go for NFO because you don't know how that fund is going to perform. So, avoid NFO when you are a new investor.